Do you rely on dividend income for your investment portfolio? If so, have you ever wondered how safe your dividend yield really is? In this video, we'll explore the risks of dividend-focused investing and discuss the key factors that investors should consider when evaluating the safety of a company's dividend. From real-world examples of dividend cuts to the impact of financial health and payout ratios, we'll provide valuable insights to help you make informed investment decisions and build a diversified portfolio that provides reliable income and long-term growth potential. Before we get started, we want to remind you to like and subscribe to our channel if you find this video helpful. By subscribing, you'll stay up to date on the latest investment trends and personal finance strategies. So, let's dive in and explore the safety of your dividend yield. To start, let's briefly review what a dividend yield is. A dividend yield is a financial ratio that measures the amount of cash dividends paid out by a company relative to its stock price. It is calculated by dividing the annual dividend per share by the current market price per share of the stock. For example, if a stock is priced at $100 and pays out $5 in dividends over the course of a year, its dividend yield would be 5%. Dividend yield is often used as a measure of the income potential of a stock investment. A higher dividend yield may indicate a greater return on investment from dividend payments. A portfolio of dividend-focused stocks can be a great way to generate passive income and to accumulate wealth over the long term. By investing in a portfolio of dividend-paying stocks, investors can benefit from the potential for both long-term capital appreciation and regular income. In addition, dividend-paying stocks can provide a measure of stability and downside protection during periods of market volatility and economic uncertainty. This is because companies that pay dividends tend to be more financially stable and have a track record of generating consistent earnings and cash flow. Whilst a dividend-focused portfolio can provide many benefits, there are also risks that investors should be aware of. 1. Dividend cuts. One of the biggest risks of dividend-focused investing is the possibility of dividend cuts. If a company's financial performance weakens or if it faces unexpected challenges, it may reduce or even eliminate dividend payments. This can result in a decrease in income for investors and a decline in the stock price. You need to remember that the decision what dividends to pay is ultimately made by the board of directors, and these are not set in stone. Directors consider a variety of factors when making this decision, including the company's financial performance, future growth prospects, cash flow, and shareholder expectations. 2. Limited growth potential. Companies that prioritize paying dividends may have less growth investment opportunities. As a result, their potential for long-term capital growth may be limited. 3. Sector concentration. Investors who focus on dividend-paying stocks may end up with a portfolio that is heavily concentrated in certain sectors or industries, which can increase their exposure to sector-specific risks. 4. Interest rate sensitivity. Dividend-paying stocks can be sensitive to changes in interest rates, as higher interest rates can make bonds and other fixed-income investments more attractive. This may cause a decline in the share price so that the dividend yield becomes attractive enough. Overall, dividend-focused investing can be a good strategy for investors who are looking for a reliable source of income and long-term returns. However, it's important to be aware of the potential risks and to carefully evaluate each company's financial health and dividend history before making investment decisions. When analyzing the financial health of a company, investors should review the company's financial statements, including its income statement, balance sheet, and cash flow statement, to assess its ability to generate cash flow. Companies with strong financials are more likely to be able to sustain their dividend payments. A company's dividend history can provide valuable insights into its ability to sustain and grow its dividend payments over time. Investors should review the company's historical dividend payments, including any changes in the dividend amount or frequency. Companies with a long history of paying dividends are generally viewed as being more financially stable and reliable. A long history of consistent dividend payments can be a good indicator of the safety of your dividend yield. Real-world examples of dividend cuts can provide valuable insights into the impact that dividend cuts can have on investors. Here are some examples. 1. General Electric. In 2018, General Electric, a well-known industrial conglomerate, cut its dividend payment by 50% due to significant financial challenges. The announcement of the dividend cut caused a sharp decline in the company's stock price, resulting in significant losses for investors who were relying on the company's dividend income. 2. Ford. In 2020, Ford Motor Company suspended its dividend payment in response to the economic impacts of the COVID-19 pandemic. The suspension of the dividend was a difficult but necessary decision for the company to conserve cash and maintain financial stability. However, it also resulted in a decline in the company's stock price and a loss of income for investors who had invested in Ford for its dividend yield. 3. Kinder Morgan. In 2015, Kinder Morgan, a major energy infrastructure company, cut its dividend payment by 75% due to falling oil prices and weakening demand for its services. The dividend cut caused a significant decline in the company's stock price, resulting in significant losses for investors who had relied on the company's high dividend yield. These examples demonstrate the importance of evaluating the safety of a company's dividend and conducting thorough research and analysis before making investment decisions. Investors should be aware of the risks associated with dividend-focused investing, including the potential for dividend cuts and the impact that they can have on their income and long-term returns. By diversifying their portfolio and carefully evaluating each company's financial health and dividend history, investors can build a portfolio that provides reliable income and long-term growth potential. If you enjoyed this video, be sure to hit the like button and share it with your friends and colleagues. Also, don't forget to subscribe to our channel for more informative videos on investing and personal finance. By subscribing, you'll stay up to date on the latest investment trends and strategies to help you achieve your financial goals. Thank you for watching, and we'll see you in the next video.